Chuck Carnavan. I'm the Chuck in the Markets Up Chuck, and today's blog was titled "When Less Yield is More." And what I really want to illustrate here is that there really is a total return concept that's very important for investors to consider. Yield is important, especially for those people who are looking for income or perhaps even facing retirement in the future. But there are times when the highest dividend yielding stock can actually be the one that generates less future income than one that may have a lesser dividend. I'm going to show a couple of examples. I'm going to show Kimberly-Clark. And I'm going to look at this company from an 11-year performance history. I want you to notice that Kimberly-Clark has had very good consistent earnings growth, but it's only grown at around 4.7%, which is not bad for a company of its stature and size. If you bought it today, you would start off with a 4.4% dividend yield, which is reasonably attractive in today's marketplace. Well, if I compared Kimberly-Clark to Cisco, with Cisco I'm starting out with a 3.7% dividend yield versus a 4.4%, but I want you to notice I've got an 11% growth rate here, more than twice as fast. And again, Cisco's had very consistent earnings growth, but they do start out with a lower yield than Kimberly-Clark currently has. If I expand these charts out to a 20-year chart, I want you to notice that Kimberly-Clark has about a 6.5% 20-year history, which means their growth rate has slowed down a little, and considering the recession, that's not bad. But, bottom line is, the company still has that same dividend yield, roughly 4.5 to 4.4 to 4.5%. But the point is it's only grown at 6.5%. When I look at Cisco over 20 years, I discovered that Cisco has grown at 12.2% over the last 20 years, which is very consistent with its last 11 years. And again, you have about a 3.5 to 3.7% starting dividend yield, which is less than Kimberly-Clark. Now let's look at what has historically been produced as a result of these two companies over these two time frames in terms of dividends. Let's start with Kimberly-Clark. If you'd have bought Kimberly-Clark in calendar year 2000, you would have started out with a 1.6% dividend yield based on the price you'd have bought it at on December 31st. I want you to notice that their dividend has grown by about the 6.5% or so that their earnings grew. So over this 11-year period, or including an estimate for 2010, you would get about $29,689 in total dividend income off of this company with a starting yield of 1.6%. If I compare that to Cisco over the last 11 years, again, the same starting date, 12/31, I would have got a 1.1% dividend yield starting out, and my total yield over this time, including an estimate for 2010, would be $32,206. But if I look at the current dividend, 09, I want you to notice in 09, my dividend was $4,651, yielding me 4.7%. And that's assuming buying and hold, and that yield is based on the original investment back 11 years ago. Now again, if I compare that to Kimberly-Clark, my dividend yield last year on Kimberly-Clark was $3,789.44 versus the $4,651 that I would be getting in Cisco. So what's happened is, because I've had faster growth in Cisco than Kimberly-Clark, my starting out lower yield actually ends up catching up to the higher yield in Kimberly-Clark, and over a longer period of time, it actually ends up generating significantly more income. Now let's evaluate this over a longer period of time. Let's look at this over the last 2 decades, since going back all the way to 1990. And in Cisco's case, I would have started out with less than a 1% dividend yield had I bought the stock in 1991, but by virtue of the fact that they grew very fast and they raised their dividend, maintained their payout ratio, dividend was growing at around a 12% rate. But by 2009, I was getting $21,905, and including an estimate for 2010, over this 20-year period, I generate about $173,813 in dividends. And now this is where the point really gets strong. If I compare that same dividend back to Kimberly-Clark 20 years ago, I could have bought Kimberly-Clark and I would have received a 3.4% dividend, reasonably consistent with what I can get today. But because it's a much slower growing company, over the last 20 years, my dividend income, would have only generated $130,907, including an estimate for 09 and 2010. But the point I make, and I guess in different fiscal years here, my point is I get $130,000 in dividends versus $173,000 in dividends from the faster growing but slower starting out company. Now, all I'm saying today is that I'm not saying that you always want to get the, the lower paying dividend stock, but, the point I'm really saying is you want to make sure you're looking at all aspects of the investment. If you've got a much faster growing company with a lower starting yield, it is certainly possible that it can end up being the highest income generator over the next 5 or 10 years. And if you're a baby boomer or facing retirement in the next 4 or 5 years and looking to build a portfolio that's going to generate income in the future, you might want to consider the growth rate of the company as strongly as you do the current dividend yield. Just don't buy the fat highest dividend yield, because often that'll be the slowest growing company. This is Chuck Arnvell saying thanks for listening. Once again, it's Friday. I won't be posting over the weekend. We'll talk to you again on Monday, and have a great weekend, and thanks for listening.